Welcome everyone. Today we will explore hedge funds in a simple and practical way. So let's begin. Hedge funds are often seen as something only financial experts understand, but I'm here to break it down for you. We will cover what hedge funds are, who invest in them, how they make money, and why they carry so much risk and reward compared to other investments. So now understand what is a hedge fund. So when we talk about the basics of hedge fund, so hedge fund is like a pool of money collected from wealthy investors. It's used to buy and sell investments such as stocks, bonds, and sometimes even more complex assets like real estate, currencies, or commodities. So now we will see how it works and what is the role of hedge fund manager. So think of a fund manager as a highly skilled investor who uses different techniques and strategies to try to grow this pool of money faster than the traditional funds like mutual funds. So the word hedge comes from the idea of hedging or reducing risk. Originally, hedge funds were designed to protect investors from losing money by balancing risky investment with safer ones. Today, hedge funds are known for taking high risks to achieve higher rewards. Now, let us understand this with the help of an example. Imagine you and your friend give an expert a large amount of money to invest. That expert uses creative, sometimes risky strategies to try to make your money grow faster than it would be in savings account. So now further we will see who can invest in hedge funds. So the first person who can invest is accredited investors. So hedge funds are not open to everyone. Only very wealthy individuals or large organization like pension funds or financial institution are allowed to invest. These investors are called accredited investors. But why there is this restriction? So hedge funds are risky and regulators wants to protect smaller investors who might not be able to afford the potential losses. So if you are not rich enough, you can't play in the hedge fund space. So now also see what is the minimum investment required to invest in hedge fund. So hedge fund often require you to invest a minimum amount like $1 million or more. This ensures that only people who can afford to lose money take part in hedge funds. So say for example, if you have $1 lakh saved, you won't be able to invest in a hedge fund. It's more for people with large sum of money looking to grow it fast. So now in the next slide we will see how do hedge funds makes money. So there are two types of fees. Number one is management fees. So hedge fund manager charge investor a fee just for running the fund, usually about 2% of the money you invest. Even if fund doesn't perform well, the manager still collects this fees. The second phase is performance fees. So if the hedge fund makes a profit, the manager also takes a portion of their gains, usually about 20%. This is called performance fees. The better the hedge fund performs, the more money the manager makes. So now let us understand this with the help of an example. Let's say you invested $1 million in a hedge fund, okay, and the hedge fund earns a 10% return. So 10% will be $1 lakh. So here the manager will take 2%, that is $20,000 as a management fees, and 20%, that is again to $20,000 of the 1 lakh profit as a performance fees. So you end up with 60,000 in profit and the manager makes $40,000. Why this fees matters? This high fees can eat your profit definitely, but investor hope the hedge fund will make such high returns that the fees is worth it. So now we will see what are the hedge fund strategies. So hedge fund use different strategies to make money. Here are some common ones. Number one is long short equity. The manager bets that some stocks will go up in the future in their value, so they go with the long, and others will go down, so they hold this short position. By doing both, they aim to make money regardless of whether the overall stock market is going up or down. The second strategy is global macro. This strategy looks at big trends across the world, like change in currencies or change in interest rates or economic policies. The fund might bet that the US dollar will rise while the Japanese yen will fall. This is an example. So the next technique or the next strategy which hedge fund use is event driven. This strategy focus on big events like mergers, takeovers, or bankruptcies. If a company is being bought by another, the hedge fund might buy shares of the company being acquired, hoping to profit from the deal. So let's see one example. If a hedge fund think a new technology will make Apple even more successful, they might buy Apple stock, they will go with a long position in Apple. At the same time, if they believe a struggling competitor will fail, they will short the competitor's stock, betting it will go down. So now we will see what are the risks and rewards in bets. So high risk, high reward. Hedge funds are all about trying to make big returns because they also come with big risks. Because they use complex strategy, they can make a lot of money quickly, but they can lose it just as fast. In hedge fund, there are less regulations, so hedge funds have more freedom than other funds like mutual funds because they are less regulated. This allows them to use riskier strategies that other funds might now not be allowed to use, like borrowing a lot of money to invest called leveraging. Now let's see a real life example over here. So in 2008 financial crisis, some hedge funds made huge bets on mortgage backed securities, which we call as MBS. When the housing market collapsed, many of these funds lost billions of dollars almost overnight. But at the same time, there were potential big gains also. On the flip side, some hedge fund that correctly predicted the crisis made enormous profit. It's a double-edged sword. Big risk can lead to big reward, but they can also lead to big losses. Now we will say, now we will see who should invest in or what is the conclusion of this entire presentation. So when we see the summary, so here it is clearly written, hedge funds are designed for very wealthy investor who can afford to lose large sum of money. If you're looking for stable return, hedge fund might not be the right fit. Okay. So if we see what is the key takeaway. So hedge fund can be powerful tool for making money, but they require deep pocket and a high tolerance for risk. For most people, it's better to stick with simpler, safer investments. So if we talk about what is the final thought, so for an average investor, sticking with safer, more traditional investment like mutual fund or ETFs might be a better choice. Hedge fund are for those who are already to risk, who are ready to risk it all for potential bigger rewards. So here, if I give you one more example, so if you invest in hedge fund and the fund makes a lot of risky bet that don't play off, so you could lose a significant part of your investment. Hedge fund are not like traditional investment where you can expect slow steady growth. So hedge funds are very good for the investors who want to grow their capital very quickly, and they want to make good returns also on their investments. Thank you so much.